All right. Good evening, ladies and gentlemen. Tariq here. Thanks for taking the time this evening to join us for this presentation on Towers on Main, a property in Salt Lake City, Utah that Anthem Capital and Summit Capital Venture Group have under contract. Starting with some legal language, just to make sure that this is just a presentation, and you will have access to, subsequent to the presentation, you will have access to private placement memorandum and all the supporting documentation if you are interested in investing in this opportunity, and do take the time to go through those documents if you are interested in investing in this. So this is a 174 unit property in Salt Lake City, Utah. It is 6 stories, and there are 2 penthouses, which is the 7th story. We have it under contract for $32.25 million. This is a 506c syndication, 506c offering, so you do have to be an accredited investor for you to be eligible to invest in it. The minimum investment is $50,000. We are projecting a total return of 116%, or an equity multiple of 2.16 over a hold of 5 years. We are offering a preferred return of 8%, and the projected IRR for the 5-year hold is 18+%. Quickly going over the agenda for the evening, we're going to go over who the key players are, an overview of the market and the property, highlights of the investment itself. We'll dig deeper into the financial analysis, disclosures of the fees, and then going over the property management, and finishing with timeline and the subscription process. So I'll just start with this here, giving you a quick background on myself. Having been out of the corporate world for a number of years and was involved in single family for some time, but Ivan and myself both, as part of Anthem Capital, have now been involved in multifamily for a number of years. And I'll summarize some of those acquisitions that we have done on a following page, but wanted to just give everyone an opportunity here to introduce themselves. Ivan, of course, as I said, is with Anthem Capital. And then we also have 2 key principals in this acquisition with us, Adrian and Pat Chung. They have been part of our Brad Sumrock ecosystem for a long time, and have been investing passively in quite a few offerings in the multifamily space. So they are joining us as key principals on this acquisition. I'm going to pass it on to Ivan for his introduction.
Thank you, Tariq. Good evening, everyone. Ivan Vine speaking here. Very excited about this Towers on Main investment opportunity. A little bit of background about myself. My professional experience comprises mainly of being a 20-year now Air Force veteran, just recently retired from the Air Force, spent my entire career flying the B-1 bomber, and also did other various projects and oversaw various teams during my Air Force career. Alongside my Air Force career, I also have a real estate investment career. Started out in the single family investment arena, and then graduated into the multifamily arena, which I've been participating in for the past 5 years. So during that 5 years, have overseen as a lead sponsor 11 properties and approximately 1,350 units. My primary role in Anthem Capital, which Tariq and I joined forces and created 5 years ago, is that I am the acting asset manager, which means oversee the operation and execution of the business plan and oversee the property management on a day-to-day basis to ensure we hit our performer numbers, that such what we're about to show you here shortly. So that's a little bit about myself. Now I'll move on over to Jason.
Hello, everybody. Put my camera on here. Jason Marcotte with Summit Capital Venture Group. William Lamb and I make up the balance of Summit Capital. Traditionally ground up developers here in Denver, but have expanded into other markets that we'll touch on later. Had interest in getting into the multifamily value add arena and met Ivan and Tariq at a conference. We thought like-minded and liked Anthem's experience in executing, especially in new markets. And we had an interest in expanding outside of Denver, just given kind of where cap rates have been in Denver, and thought that there would be opportunity to identify other markets or other deals in different territories. And we identified Salt Lake really as a place where we found or could find value. As such, we spent the better part of the past 2 years trying to identify opportunities in Salt Lake. And William Lamb, who's our acquisitions and development manager, I'll pass it to him to discuss his experience and a little bit more about and how we found this asset.
Thanks a lot, Jay. Hi, everybody. My name is William Lamb. I'm in charge of sourcing and acquisitions for Summit Capital, and really happy to share this opportunity with you guys today. As Jason mentioned, we're primarily ground-up developers in Denver, Colorado, but we've been actively pursuing acquisitions across the West from Denver to Salt Lake. I happen to dig this baby up, and I'm very excited to share it with you. On a macro level, I'm really excited about this deal because Salt Lake is just booming right now. Employers can't find enough workers to fill the number of jobs out there. And as a result, unemployment in Salt Lake is one of the lowest in the nation. With all the people moving out there to fill those jobs, occupancy rates have also been through the roof for a lot of acquisitions. So specifically this property, it's centrally located. It's near tons of bars and restaurants with a great walkability factor, and top-notch ski resorts and mountain biking is just 30 minutes outside your door. So with that, I'll turn it over to Tariq to speak about Anthem's track record, and look forward to telling you guys more about the project.
Thanks, everyone. I will just highlight a couple of things on this slide, going over our track record. You are going to get this as part of the slide deck with the webinar recording, as well as this will be included in the business plan that is going to be part of the private placement memorandum and supporting documents. So we have had acquisitions holdings in Oklahoma, Arkansas, Texas, Arizona, and Florida over the years. Have significant experience with all kinds of financing. Have had Fannie, Freddie loans, bridge loans, bank loans, multiple of them. There are properties that we have refinanced and held on, properties that we have refinanced and sold. And it has, from an acquisition value standpoint, a little under 140 million in acquisition value, and have raised about 48 million in equity for those acquisitions. Our average hold period has been a little under 3 years, and we have averaged across the portfolio that we have exited about 25+% annualized return on the ones that we have sold at this point. I'm going to pass it on to Jason to cover Summit Capital's track record.
Thanks, Tariq. As previously mentioned, traditionally ground-up developers, as such, our development timelines and execution timelines are obviously much longer. For us to create value, a lot of times these projects or project life cycles exist for up to 5 years. But as you can see here, we've executed on deals in the $155 million range and created profits to the tune of 33 million, resulting in a 21% return on investment. And I think what's important to recognize is that this particular deal, where acquisition cost is roughly 32 million, and our execution or deal cost is roughly 35 million. It's really right in our wheelhouse, and as far as deal size, and allowed us to use some of the key players that have come to the table to finance this particular asset, which we'll touch on later. At this point, I'd like to hand it off to Ivan to talk more about Salt Lake and why we're excited to be here.
Thank you, Jason. As Will already alluded to, we have a lot of excellent economic activity going on in Salt Lake City market, and specifically in submarket where Towers on Main sits. As you can see here on the map, it's just south of the downtown area and just west to the Sugar House District. This is significant because there's an extensive amount of growth going in both of these areas, which comprises of various things like growth in retail stores, bars, restaurants, and also job growth. So given where Towers on Main is, it's right in the crosshairs between both of these growth streams. And our goal is to capitalize on that and acquire a higher demographic, better demographic of tenant in which these areas are drawn them to. And so that is very significant in this offering, is the actual location of Towers on Main. Additionally, also want to point out that it's very, very close to major thoroughfares. We got I-15 to the west and I-80 to the south. And as such, people have easy access to a variety of employers all around Towers on Main. And in fact, only within 10 to 15 minutes drive, we have 500,000 plus jobs within a 10 to 15 minute drive of Towers on Main. And that makes it very, very enticing for someone wanting to live in that area. And it's actually relatively easy to get to these job centers, which gives us very strong reason to believe that people are going to desire and want to live at Towers on Main. Also, I want to point out that Towers on Main is very close to the Wasatch Mountains and other major employers, blue chip employers as well.
Just wanted to chime in and highlight, Ivan mentioned that the growth that is going on in the area, just to give you an idea of the quality of the retail and quality of the businesses that are moving in the area. Just a half a mile south of Towers on Main, Tesla has recently opened up a dealership. And just a half a mile north of Towers on Main, Porsche has opened up a dealership there. So that gives you an idea of the quality of the demographic and the quality of the tenants that are there in the area.
Yeah, absolutely. And here's a slide of just some additional employers that have a significant presence in the Towers on Main area. We have the healthcare industry established there. 30-some thousand plus jobs, as you see on the slide there. We have a significant job presence in the financial services, as well as in the fulfillment center for like Amazon and data centers like Facebook. Also, as Will already mentioned, want to point out the very, very strong unemployment rate. In August, it just went down to 2.8%. And that is very, very good compared to the national average, currently about 5.2%. And this is significant because it just lends to all the job growth going on in the area in light of COVID and all the issues surrounding COVID with the unemployment rate going up. In fact, in Salt Lake City, it's gone down and it hasn't been negatively impacted by the unemployment rate going up nationwide. And again, it's just right by the Wasatch Mountains. And so Towers on Main is a very attractable place to want to live, especially for those who like to get away on a weekend for a quick and easy getaway and to have a good traveling experience.
I think, Ivan, I just wanted to add, for those of you that haven't been to Salt Lake, because I think it's hard to understand or appreciate how close it truly is to the mountains. My wife and I went there for a wedding years ago and rented a car thinking that we need it to get up to the mountains. But in actuality, you can jump on an Uber. It's only 25 to 30 minutes to the heart of Park City and the entertainment and ski centers up in the mountains. So key driver of quality of life and another reason people are moving to Salt Lake. Absolutely.
Absolutely. Okay, moving on. Now we're going to open up with the overview of this investment and of this actual building, the physical aspects of this building. As I already mentioned, 1963 building, 174 units, 6 stories, with that 7th layer being the 2 penthouse suites, the 3-bedroom, 2 baths at the 7th layer. And it's important to note that about 14% of the interior units have already been renovated by the current ownership. And we'll talk a little bit more about that in detail here later on. Also want to point out that we have a commercial lease on site where someone has leased out a certain area at the first floor, and they have a cafe in there called Penny Ann's Cafe. And they just renewed the lease for 5 years. And that will bring in roughly $30,000 of revenue on an annual basis, which is very significant. So our plan, Anthem Capital, Summit Capital, we plan on going in and improving up to about 75% of the overall unit capacity on site, so about 106 units. And our goal is to bring those units up to market standard to fulfill a price gap, yet still create affordable housing in the vicinity of downtown area and the Sugar House area and the Wasatch Mountains that we already explained. Also want to point out, this is a joint venture agreement that we have with Electric Capital. Electric Capital is a private equity group, and they're providing majority of the equity needed for this deal, about 71% or $8.9 million of the equity. So this syndication, we're focusing on the remaining 21%, whereas we're bringing about $3.6 million of the equity and syndicated through Class A shares. Okay, some more information about the building itself. I mean, you saw the pictures already. You saw that the exterior of it is made of a steel frame with cinder blocks, cement walls, a very sturdy building, a lot of life and longevity left in the building itself. Also want to point out that the heating and cooling is done by boiler and chiller systems. We did the full due diligence process. They're approximately 7 to 10 years old. We don't necessarily see a need to actually replace them, but we do see that they need some love, attention, and care, and we'll go into more detail about that here in a minute. With regards to parking, plenty of parking spaces, and that's incorporated into our business plan to also include reserved parking as well as covered parking for additional revenue opportunities. And interesting enough, we're actually renting out some ceiling or roof space to a cell phone company to realize additional money through cell phone leasing towers. So also want to point out it's a flat roof, TPO roof, roughly 9 to 10 years old. We don't see a need to replace it. We do see that we're going to have to do some ongoing maintenance, as you always would with any type of asset such as this. To the right, very important, want to point out 50,000 median household income with 1 mile. It's very strong, very significant. And that gives us confidence that we'll be able to realize our rent bumps and attract the type of demographic that we're going after for this particular opportunity. Also at the bottom, it's also important to note that the current ownership has invested $2 million in capital improvements, and it shows. You see what they invested the money in, including the courtyard, swimming pool, office, exterior paint, weight room, and common area. So here's some pictures of that. You can see the top slide, the pergola in the back, open seating areas, very family-oriented type space for kids to come and play, and also give areas for people to sit and relax. In the bottom middle slide, this is what the interior common areas look like and the office area looks like. Very modern, very new looking space. Bottom left, what I want to point out is just a view. I mean, that is a really nice view, beautiful view, and the mountains just off beyond the building itself.
Hey,
okay,
let me bump in here and just mention real quick that I see some folks sending in some questions in the chat. I just want everybody to know that at the end of the presentation, we will get to your questions and we will answer all of them.
Thank you, Will. Appreciate that. All right, moving on. All right, now we're going to get into the investment strategy for this particular opportunity. Very simple, 3 major components. With the investment strategy, we're going to implement our capital improvement program. We're going to perform operational improvements and also utilize a sound exit strategy. So with the capital improvements, 2 major components. You got the interior component, you got the exterior component. With the interior component, like I said, we're going to bring up those 106 remaining units up to market standard. We're going to provide 2-tone paint, final plank flooring, update the kitchen, and we're just going to make a pop. New lighting fixtures, ceiling fans, stainless steel appliances. With the exterior, again, not really replace the boiler and chiller, but provide a preventative maintenance plan and give them a little bit more attention, love, and care, and address some of the deferred maintenance items. The same with the roof. There are some electrical upgrades needed, especially in the boiler chiller areas, which we will address, as well as address stairs and landing improvements and landscaping, which is typical for any type of new acquisition. So moving on to the operational improvements, we'll spend a little bit of time on this with bullet A there. In conjunction with a professional third-party property management company, we're going to continue to increase the rents, not just for the units that we're going to improve, but for the classic units. We're going to burn off that loss of lease. How are we going to do that? We're going to be aggressive. We're going to get in there. We're going to push the rents. We're going to be very stringent on our rental criteria. We're going to demand and attract a higher, better demographic and a higher, better tenant that's going to pay better and more in rent just by putting the demand on the market, which we've already alluded to is a very, very strong market. And again, we're going to go in and we're going to upgrade those 106 units, and we're going to talk in detail what that's going to look like on an interior improvement plan here in a minute. And as we improve those interiors, we're going to raise the rental criteria. It's just naturally going to upgrade the overall property. We're going to have a transformation. Typically, an asset takes about about 2 years to go through a full transformation, but you trade out approximately 50% of the tenant base on the first year. So we will go through that major transformation process as we improve the property. Also, keep in mind that the current ownership has already proven the value-add approach by upgrading those 25 units and realizing those rent bumps. And as we said, we're going to get a good property management company there. When we're on site, it just didn't have the buzz, didn't have the pop and zeal that you normally see in a very bustling office of a very aggressive property management company. Phone calls weren't getting picked up. You didn't see people in and out. You just got to get new life in there to push this property. Also, we're going to do a cost segregation study. This is going to help us realize very good tax benefits. I'll have a slide on that in a minute. And thirdly, the last point, we're going to utilize a sound exit strategy that is built into our underwriting, built into our pro forma, and we're underwriting on a 5-year basis. Doesn't mean that we're going to hold it. We have to hold it through the entire 5-year period, as Tariq alluded to. Typically, a lot of times these assets mature at a lot earlier pace, and which allows us to exit at a lot earlier time. Moving on with regards to this cost segregation study, yep, we were going to hire an outside consultant to perform a cost segregation analysis. And what this will do will allow us to determine the value of the asset itself, the property itself, and be able to depreciate that over the course of 1 year, in the year of acquisition, up to 100%. Again, please do make sure you consult your tax legal professionals. This is by no means any professional tax or legal advice, but based upon our own understanding, what you see, there's a rule of thumb: 75% of your investment, whatever that is, can be taken as a loss in year one. In this case, if you invested in this example, $100,000, 75,000 of that would come back as a tax loss in year one, as represented on your K-1 tax form. All right, now I'd like to hand it over to Will.
Thanks a lot, Ivan. I really appreciate that. And I just want to remind everybody that the presentation is being recorded and that all the slides and the presentation will be available for everybody to view after the recording finishes. So we're going to be looking at a lot of numbers here over the next few slides. Don't feel like you have to write a lot of information down. It will be available to you later. So right now we're taking a look at what our unit mix looks like for the property. We've got 127 one-bedroom units, 45 two-bedroom units, and as Ivan was saying, we have 3 two-bedroom penthouse units on either side of the towers. On our left side, we see a representation of the unit mix and where the current rents are and where our pro forma rents are going to be. Now at the bottom here, I'm circling in red, $1.59 per square foot. That's where the current rents are. What we're hoping to do is cure that loss to lease, continue to implement those upgraded units, and then really push those rents up to $1.90. That translates to roughly a 20% rent bump. So moving on to the next slide here. Now we're looking at some of our comp set. There's 8 shown here, but we actually surveyed 12 in total. Those range from older assets to newer builds, and what we're seeing is that there's a lot of new development making its way towards the towers on Main from the CBD to the north and the Sugar House area to the east. Now most of the newer developments that are near us are Class A properties, and they're expensive, right? And so it really leaves a lot of the middle of the pack renters out in the dark there, because they still need to be centrally located to fill the jobs I was telling you about earlier. And that's really where the towers on Main comes in and solves a problem. We're providing an affordable option with similar amenities to a lot of these other buildings, including a pool, a gym, and a club room. And when you look at older assets in the area, they just don't have that amenity package. So here's the same information for our 12 rent comps, and they're all arranged right here. In the bottom, you'll see the Towers on Main current in blue. That's showing our current rents at $1.59 per square foot, or an average rent per unit at around $1,000. We're going to try to push that up to about $1.90 per square foot and $1,206 average rent per unit. Now, I think that makes a lot more sense in the next slide. So right here on our left, we see our rents in $1 per square foot ranking. And then on our right, we see our rent comps and average asking rent ranking, right? So this is the monthly rent that you're paying out. We're seeing that in blue again, the Towers on Main is just the bottom of the pack here, just over $1,000. And what we're trying to do is we're trying to upgrade those rents and get them closer to around that $1,200 mark. What we see is that our average asking rent right now is just around $1,400. So that's like a $200 gap right there. And you know, when you're going out there and you're taking a look at all these different properties and seeing what's within your budget, that $200 really makes a difference. And that's why we think we're going to be successful here. So moving on to the next slide, this is the same information again, and it's shown with our studios and the average rents ranked again at the top right, and then on the bottom right we're showing our 1-beds and 1-baths. So we're going to be upgrading our rents on our studios from $850 to $906. It's not a very big bump, but we only have 12 of those units in our building, so it's not really super important, and it's not really where we're achieving the most bang for our buck. Now, where we are starting to see that is with our 1-beds, $990, bringing those up to around $1,120. That's what we're seeing right here, this big gap. So when you look at where the next affordable 1-bedroom is, you're going from that $1,100 mark up to around $1,300. And that might just be out of budget and out of range for some folks. Moving on to the next slide, same information, but shown for 2 bedrooms on the top right, and then 3 bedrooms on the bottom right. I'm going to focus in on the 2 bedrooms because, again, that makes up a majority of our building with 45 2-bedroom units. We're going to be taking those from $1,100 all the way up to $1,450. Now, when we look at kind of the comp set here, these guys, the Hillcrest, the Kensington, Royal Farms, all of those buildings are 1920 vintage or 1980s vintage. Whenever you get to something that's brand new, your 2 bedrooms are all the way around $1,800 a month, and people just can't afford it. So we're coming in, we're solving that problem, and we're providing people with an affordable solution. So with that said, I'll turn it back over to Ivan to discuss a little bit about the rehab budget.
All right. Thank you, Will, and nice job. Yeah, very excited about that rent bump plan. All right. What we have in front of us here is a rehab budget. What you can see here at a very high level is a very healthy rehab budget. We have allocated roughly $2 million to take care of all of the capital improvement needs throughout the entire holding period. Majority of that is allocated toward the exterior items, and then roughly 57%, and the other half, 43% or so, is allocated towards the interior items. With the exterior items, you see major components there, major mechanical components, roof repairs, chiller, boiler, chiller, piping, etc. Those numbers there are allocated for a worst case scenario in the event of a catastrophic failure, and we had to replace some major components of the system, then we have allocated a healthy amount towards that. However, as I already said, that is not our rehab plan. Our rehab plan is to go in and give these systems the attention and care that they need. And we just saw through our own eyes and through our own due diligence process, through consultation with third parties, that they just need some love, attention, and care. And that budget is a much smaller budget, but will come out of these buckets, but obviously at a lot smaller percentage and basis. So again, we just want to be smart with our budgeting, smart with our planning, and have extra funds there just in case we need them. I also want to point out in the exterior budget that we have $250,000 still set aside for any additional mechanical repairs that may be needed. Also not illustrated here, but as part of this budget, want to point out there are 3 elevators on site. One that has been fully repaired and rehabbed, and 2 others that have been partially repaired and rehabbed. In the event those two need to be, partially repaired or rehabbed elevators need to be improved, some of the funds set aside in the mechanic reserve bucket will go towards that. Moving on to the interior budget, again, roughly $6,000 per unit in improving around 106 units. We feel that is a very significant amount of money, and we still have another 212 set aside for additional interior improvements in the case we need it. So been doing this for a while. I have overseen multiple rehab projects through various markets and sub-markets. We feel $6,000 is a very healthy number to be able to hit our pro forma rent bumps around $150 on average. All right, so next slide. Just breaking down the rehab timeline expectations. In the event we're performing any boiler, chiller, anything like that, yeah, of course, we'll do it at the appropriate time of year such that we will not make it colder in the winter and make it warmer in the summer times if we had to improve those particular components. But when we get our hands on this, we're going to do another complete deep dive. Yet we do have our third parties ready to go. But we want to do one more deep dive just to make sure we fully understand everything before we start executing a rehab plan. But once we start doing that, especially with the interiors, what we plan on doing is improve about 9 units on a monthly basis. And we'll have a breakdown of what that looks like and a timeline here on the next slide. Also with the interior improvement plan, as with any asset, you want to test the market. You don't want to go in and just improve all 106 units and push play and see what happens. No, you want to take certain data set of each unit type, test them with do A/B testing, and optimize what that improvement plan is. Because it's not just a function of improvements to match the market. Yes, that's important, but it's also a function of who you're working with in the property management company and what their ability is to execute and how they're able to do the sales piece to getting people, the right kind of people to live on our property. But once we test the market, we have a clear understanding of what that is. Yeah, but then we'll scale that out across the board to finish off the interior improvement plan. Of course, we're going to be working with professional third-party contractors. We'll be heavily involved in the GC component of this. Do this full time. I plan to be on site numerous times to make sure we have successful execution of the rehab plan. Now I'd like to hand over to Will, and he'll break down the renovation schedule.
Thanks a lot, Ivan. So again, we're going to be jumping into a bunch of numbers here, so don't feel like you need to write any of this down. It'll all be available to you later on. This is a look ahead at our renovation plan and how we're going to roll it out over the next 2 years. What I'd like to focus on is this square at the top left corner. Talks about the phase in of renovations. So as Ivan just mentioned, we're planning on doing 9 units per month to renovate 106 total units. So that's going to take about 12 months to finish up. As Ivan said, we're going to get there, get in the lay of the land, find out how the building's operating, see how we can push and cure our loss to lease without renovating units. And then once we have a really good game plan, we're going to implement it, roll it all out, and then see this go. In the very end, I think that I'd like you guys to focus in on the fact that we're going to have 133 renovated units and 41 units that have not been renovated. So you may be asking yourself, why? Why wouldn't we take it all the way? Well, the answer to that question is that we want to leave some meat on the bone for a future buyer. Later on in 5 years or less, when we decide to sell this asset, it really gets a future buyer motivated that there's still a little bit of additional revenue and value that they can unlock at a later date. So just taking a look here, property repositioning, the interior unit renovations really kind of focus on 2 areas, the bathrooms and the kitchens. On your right, you can see a snapshot or a picture of a renovated unit. And in that unit, we're showing some stainless steel appliances, quartz countertops, LVT wood flooring, new lights, new cabinets, hardware, fixtures, and things like that. So this is our first little foray into the financial analysis of the project, and specifically the project budget. So we can see our acquisition metrics here. We're going in with an acquisition cap rate of 4.35%. Next to that, you can see our sources, including our debt and equity. Jason's going to speak to that in a little bit more detail on a future slide. Next to that, you can see our uses and our total budget for the project coming in at around $36.3 million. We've broken that down in more detail for you guys on the bottom left table. That's the total acquisition breakdown, everything including the listing price, fees, closing costs, CapEx, etc. And those closing costs are expanded on the right side there. We just wanted to give you all this information to be transparent and let everybody have all the tools necessary to make the right decision on this investment. Now, moving on to this next slide, we're looking at our financial analysis and the pro forma. I think really what I'd like to focus in on here, we're going from our effective gross income through our operating expenses to our NOI at the bottom of the page. Our T12s are showing that we're operating right around $1.6 million annually. By implementing our unit renovations and our updated OpEx and new property managers that are just motivated to get this property working a lot better, we're going to see that change to about just under $2 million in year 2. And then we take that all the way out to year 5, we're at $2.3 million. That's based on an average annual rent growth of around 3.3%. And an exit cap at around 5.25. Moving on to the next slide, we can see our operating expenses here. So on the left column, you'll see our T12 operating expenses right at $5,800 per unit. We're bringing in that new property manager. We're doing all these unit renovations. And what you'll see is that a lot of our contracted services that we would have spent money on repairing a lot of these units or making repairs to the mechanical systems and things like that are just going to get dropped down. And so what we'll end up working with is around $5,300 in per unit in OpEx. So again, here we're looking at our pro forma, and we're seeing a steady increase in our net operating income from when we take it on in year 0 at around $1.6 million all the way out to year 5. Bringing that up to $2.3 million. Below that, you can see our levered return cash flows. And then what I really want to focus in on here is the return metrics at the bottom, right? We can see that 4.3% going in acquisition rate. By the time we get out of this property in year 5, we've increased that income all the way to get us to a 6.4 operating cap rate. That's pretty darn good. And when we sell at a 5.25% cap rate, that really leaves us over 100 basis points of a spread in unlocking that value. So that's really going to turn into some really great returns later on that Jason will further elaborate on. So Jason, with that, I'll turn it over to you.
Well, can you just go back to that slide, the previous slide? I just want to make one comment there. I just wanted to highlight one thing that this is just development of today, that we got the appraisal back from the lender, Berkadia in this case. CBRE did the appraisal. Our contract price is $32.25 million. The current appraisal as is has come in at $33.3 million. So that is a good $1 million above our purchase price. And then we had also requested for an as stabilized appraised value by the end of year 2, having discussed with them the plan that we have to renovate 106 units. And that has come out at $43 million. So 33.3 as is and 43 million as stabilized by the end of year 2. So, compare that to what our projections are, that selling out in year 5 at 45 million, I think we would be well on our way to achieve that ahead of that timeline if we are able to hit our plan as projected here. Thanks, Jason, back to you.
Thanks, Tariq. Here we have what is a very common organizational chart for a deal of this structure. We've got our borrower entity, which will actually hold the property. From there, it flows down to the Towers 1810 Main JV, which is our JV with Electra Capital, who is a private equity shop back east that will be bringing 71% of the required equity to the deal. And alongside that, you'll see our syndication entity, which is the entity that will be funded by those that elect to invest after today. The Class A is the class that will be invested into by the investors on this webinar, and then the Class B is ourselves as sponsors or GPs. As alluded to earlier, we will be working with Freddie, who gave us some very aggressive terms on the debt side. And then the balance of the equity will be made up of Electra, who's bringing 8.9 million, and we will be raising roughly 3.6 million as we move to close on 9/30. The way that the cash will be distributed upon operations and/or liquidation would be first to pay the debt, second to pay Electra, and then lastly to pay the Class A and sponsors. This is an important slide. I think we've represented that we believe this to be a relatively strong investment with the 18.1 IRR. Part of the reason we're able to offer that investment offer that IRR is because we do have Electra coming in with relatively aggressive terms to be a part of this. The waterfall is structured as such. There's two different waterfalls. One waterfall for distribution of operating cash flows, and another waterfall during a liquidity event or a sale. During the operation, we are giving our investors an 8% preferred return on their capital before we as sponsors participate. So we want to make sure that our Class A investors hit that 8%, and then anything above that 8%, we as sponsors collect. And then I think it is important to note that the 8% pref return is accrued. So if it doesn't hit it in a given year, the balance carries to the following year. And then in the event of a sale or liquidity event, we have another IRR hurdle of 15%. So we want to make sure our investors get the 15% IRR before we as sponsors participate. And when I say it's 15% IRR or a 1.9 equity multiple, and then after the investors hit that, then cash is split 80-20 in favor of the sponsors. As currently modeled and based on underwriting, we are suggesting that the Class A investors will see a return of 18.1% IRR, an equity multiple of 2.16, and general yearly cash on cash of 7.3. And at this time, I'd like to pass it back to Ivan.
All right, can just go back to the previous slide there for a minute. I just Tariq here. So just wanted to go back to the point that Jason just highlighted, that there is, for the passive investors, there is first, and for the holding periods, during the holding period, while there is operating cash flow, there is an 8% preferred return to the passive investors, and before any money comes down to the sponsors. If there is any shortfall in that, which is likely to be in the first year, the balance is accrued to the capital account. So the passives are going to be made whole for that 8% preferred return before sponsors see any cash flowing to them. And then on the back end, 100% of the capital event proceeds go to Class A shares, goes to passive investors until they hit one of the two hurdles, either the 15% IRR or a 1.9 equity multiple. Once that is hit, that is when proceeds start flowing to the sponsorship team, 80% to the sponsors, and still 20% participation by the passive investors even at that point. So just wanted to highlight that that is pretty strong offering, considering there is little or no cash flowing to the sponsorship team during the holding period, and that is just our belief in the opportunity that we are willing to do that. With reference to the debt, as mentioned earlier, Berkadia is the lender. It is a Freddie Mac floating rate loan. The loan amount is $23.8 million. We have locked the spread, and that is starting out at 2.87%. It is 5 years of interest only period. It is a 10-year term loan, but 5 years of interest only, which helps with the cash flow during the holding period. And then since it is a Freddie Mac floating rate loan, there is a 12-month lockout. And after that, there is only a 1% prepay. So if we needed to, whenever we need to exit this acquisition, the prepayment penalty would be something that we can manage. Want to go over the fees that are being charged in this acquisition. There is an asset management fee of 1% that goes to the sponsors, the asset managers. There is a property management fee of 3% that goes to UV Residential. That is the property management company. There's an acquisition fee of 1.75%, but 1% of that is paid at closing, and the other 3/4 is carried on the back end and is paid only if that 15% IRR hurdle or the 1.9 equity multiple is achieved. If those are not achieved, that the balance of that acquisition fee is not paid. Same thing with the disposition fee. There is a 1% disposition fee, but that is not applicable on a capital event only. It only kicks in if one of those two hurdles of the 15% IRR or the 1.9 equity multiple is achieved. There is also a GC fee of 5% for the CapEx spend. There is significant CapEx, significant work that is going to be done at this asset. So there's a 5% GC fee to support that. I'm going to now pass it on to Ivan to go into the property management.
All right. Thank you, Tariq. Right. Yeah. The property management company that we're working with is UV Residential. The point of contact there that we've been working with primarily since the beginning of this acquisition process. Her name is Jenny Romera. I tell you, we really, really like Jenny Romera. She's a very, very experienced and knowledgeable of the Salt Lake City market. The previous company she worked for, she oversaw approximately 50 different communities in the Salt Lake City market, which encompassed about 10,000 units and 32 different ownership groups over the course of 7 years. Very well-versed, very knowledgeable, very experienced operating in Salt Lake City. And even with this property itself, she was at one point in time an actual manager over this property. And one key thing I want to point out is that it's great to go through this business plan, talk through the numbers, talk through how we're going to execute, but it's all about the people at the end of the day. It's about these people that are going to execute this and get it done right. And I tell you, we have a lot of faith, a lot of confidence, a lot of trust in UV Residential. And we put a lot of time underwriting them and making sure they have a clear understanding of what our expectations are and how we plan on achieving these pro forma numbers. And also that so she can clearly explain to us how she expects to hit these pro forma numbers. And after going through those discussions, obviously we're very, very comfortable in their ability to do so.
I just wanted to highlight that, Tariq here, just wanted to touch on the fact that we have taken multiple trips to the asset at this point and have met with various equity partners. And every single time we have met with the property management company's staff that is there, including Jenny herself. And the grasp that they have of the market is just amazing. The plan that they have and the what they are achieving and able to deliver on some of their other assets that they are managing, that all plays into it. So there is a very detailed work that has gone into coming up with the plan that we have presented.
Yeah, absolutely. Detailed work and just also just the energy that this team has. New energy, a lot of excitement, a lot of enthusiasm. We picked up on that very early on in the beginning of our relationship with UV Residential. Okay, winding down here. Here's the timeline that we're following towards the bottom of this timeline now. Today, obviously, is the investor webinar. Subscription is going to be open today. It's actually live now as we speak. And I do want to emphasize we had a lot of interest in this opportunity. For us, I mean, we've done 11 plus offerings, and this is the most amount of people that we've ever seen register for an offering. So if you're interested, highly recommend that you get on IMS now, which I'll explain to you how to do that here in a minute. We'd like to give you 10 days to get those subscription booklets due, but again, I highly emphasize you get those done as soon as possible to reserve your spot in this investment deal. It's first come, first serve basis. And then lastly, whoever supplies the money first will have priority in this deal. Wired funds due date the 24th. We're on track to close by the 30th. Yeah, a lot of moving parts going, but we're on track. We have multiple weekly calls with all of the various entities involved to get this done, i.e. the lender, the lawyer groups, the property management company, etc. And things are moving along great. Okay, with that now, I will go into subscription process later, but let's open up the floor for questions and go through some of those.
Right. So a couple of questions that have been asked more than once. One, is this, us being part of the Brad Sumrock ecosystem, if this is a deal that has been reviewed by coaches, and are the sponsors all part of the Brad Sumrock ecosystem? Yes, the deal has been reviewed. There is a deal disclosure form that has been provided to the support staff and to the coaches, and everyone involved in the sponsorship team as well as the KPs are all personal students within the Brad Sumrock ecosystem. The other question that has been asked is how much money are the sponsors putting into it, and 10% of the equity raise is being put in by the sponsorship team. Ivan, you probably want to touch on this with reference to the fact that this is the 506C syndication, the accreditation process.
Yeah, integrated with our online portal system, IMS, is a third-party company called Verify Investor. And when you subscribe, you can select that third party to do the verification process for you on your behalf, and that cost will be incurred through the deal itself, so nothing out of your pocket. Highly encourage you to use that process, but there are additional processes that you can use. You can get a letter verification from your CPA. You can use an attorney. You can use other professionals. All of the different ways to verify your accreditation status is spelled out in the investor documents, specifically in the investor questionnaire section. And in there, you will see all the various ways to verify your accreditation. But again, the easiest way is to use the integrated process into IMS, Verify Investor.
Ivan, this one is probably in your sphere as well. With reference to the vendors, the third-party contractors, what kind of relationships, what kind of diligence has been done to come up with the budget, and also specifically with reference to the elevators, both the budget and the diligence?
Yeah, so
I was going to say, I can speak about the contractors that we've talked to, and then I can turn it over to Ivan for the elevators. But during our due diligence period, we have spoken with and had two very large commercial contractors out to the site for pricing purposes and to give us some guidance during the due diligence process. They are both very well known in the area, and we're happy to share those references with you guys.
Yeah, and additionally, also want to highlight the fact that we're going to leverage UB Residential's relationships with the vendors in the market now, with all of their general contractors as well as their suppliers, to ensure they get the most cost-effective basis across the board when it comes to labor and when it comes to materials. With regards to the elevators, I'm in direct contact with the person who's overseeing the rehab projects as we speak. He has been on site, and he has given me a full understanding of what the history is with these elevators, something that is difficult to get out of the sellers. I was able to go to the source of the man who knows the ins and outs. So I'm keenly aware of what that is. And with regards to the budget for the elevators, again, that's coming out of the 250,000, but allocated towards the elevators, roughly 100,000 or so on a worst case basis. And again, that's covering 2 different elevator systems, right? And there's some challenges because a little bit older components, which may be difficult to find. But again, we have a healthy amount allocated towards this in the event we have to exercise the rehab budget for the elevators.
Thanks, Ivan. This question, and Jason, maybe you can address this. The waterfall or the return thresholds or hurdles for the JV equity partner, Electra Capital.
Yeah, no, absolutely. Good question. So Electra's JV agreement includes a 9% preferred return on operating cash flows. And at the time of sale or liquidation, they have a 12.5% IRR catch up. So those are the terms that Electra has sought. I also see a question in here about the floating rate for Freddie, which does include an interest rate cap. If you'd like to touch on that, Tariq.
Right. So with any floating rate loan, there is a cap that the lender requires us to buy, and we have budgeted for that. We're going to buy that for the duration of for the 5-year period that we intend to hold it. The question is why a floating rate loan? That is where the loan proceeds were maximized there, and the prepayment penalty that is minimal at 1% after the first 12 months. So that is a major factor as well. We were getting the maximum number of years of interest only in that as well. So just a multitude of factors that pushed us towards getting an agency floating rate loan. We did look into bridge loans for this as well, and actually bridge loan proceeds were about 2.5-3 million more, and we could have gone that route, but chose to stick with agency just because of lower interest rate, the fact that we have a longer term. We don't need to go into extensions and meeting hurdles for the 3+1+1 extensions down the road. So the costs associated with getting into and getting out of bridge loans and extending the bridge loans, we decided not to do that. So that is why we are going with the floating rate loan from Freddie Mac.
Take this one. All right, we have a question here. What are the roles of each of the sponsors, and how we're executing our roles on this particular asset? Well, as I mentioned earlier in the webinar, maybe I didn't, but I'm going to be the primary asset manager for this, which is my role overall in Anthem Capital. But in lockstep with me, we're going to have Will Lamb as well, be a part of the asset management process. Already got plans to be on site next month. We want to hit the ground running and quickly get the property management company integrated and help them get integrated with the property itself. Of course, we have oversight from Tariq and Jason. Tariq's overseeing the cash management process, the transactions that go on an ongoing basis when it comes to overseeing the financials, and also lender relations and on that front. But my role primarily is to work with the property management company to ensure that we successfully execute this business plan.
I saw some questions about some of the financials. I can touch on those if you'd like.
Go ahead.
Yep. I saw a question about from Jeff asking about the EQ fees. I think that was just if you look at the total acquisition breakdown later on, that has all of the line items broken out separately. I think in the uses, what you saw, the EQ fees as $855K, that's really including a lot of different financing fees in there as well, including an interest reserve for our financing and a rate cap for our financing. So that number may seem like it's a lot higher than it really is, but I would focus in on the total acquisition breakdown to get some full detail into all the line items that we are carrying in our budget.
Do you want to?
And this is.
Go ahead.
So, sorry, I want to circle back to the Electra question, and I think it might be prudent to to perhaps update the business plan to make sure it's more called out. But I think what I said earlier was that Electra had a 9% pref and then a 12.5% catch up. But actually, the terms are that Electra receives 80% of cash flows, and our syndication entity receives 20% of operating cash flows. And if for whatever reason the asset does not cash flow at a 9% preferred return to the Electra, there's a reserve that is drawn to make them whole at 9%. And then at the end of the deal, they have a 12.5% catch up at sale. So I just want to make that kind of clarification, and I can go ahead, Will.
Let me add on to that. After Electra hits their 12.5% return, then our group, the Class A investors, will then start to receive 80% of the cash flows thereafter. So it's a very important part to mention there, that Electra's hurdle is pretty low, and once they get made whole, then our group stands to receive the rest of those proceeds.
Thanks, Will.
The other thing also, Jason, if you want to touch on, is the fact that the 80-20 split of the operating cash flow changes to 75-25, right?
Correct.
Right. So if you can, do you want to elaborate on that? After
the Electra's return on their cash is beyond a 10% for, I believe it's 6 months, then the cash flow split goes from an 80-20 to a 75-25. And that was just to, we negotiated that late in order to make sure that we had the operating cash flow we needed to give our investors close to that 8% cash on cash. So yeah, I also think you very important designation too.
Right. And another question with reference to the 8% pref for Class A paid after the 9% pref to Electra. Yes, that is correct. Electra gets 9%, but there is as Jason just said, there's an 80-20 split of the operating cash flow. And to the extent that 9% is not hit, there is that part of the closing costs. There is a reserve set up front of $270,000 to support if there is any gap that is there to meet that 9% pref.
And piggybacking on that, Tariq, right now the cash flows of this property are very strong. Our occupancy is at 98%. We're working on, I think one of the first things that we're going to be doing when we get into the property is to be burning off that loss to lease, further increasing the cash flows before we even start up the renovations. And what that does is it really does show that this property is cash flowing in a healthy way, enough such that the Electra guys are receiving their pref and made whole, and we're still able to offer our Class A investors an 8% preferred return. That's translating into a 7.3% cash on cash annually as currently modeled.
Right. And I'll also point out, you mentioned that the occupancy continues to be high, 98, 99% consistently. Over the last 5-6 months, the income trend has been very strong, and every single month income has trended up by a few $1,000s and continues to do that. We did receive the August financials as well, and that is higher than July, which was much higher than June, which was higher than May. So there is a consistently uptrend at the property already in place, indicating very strong rent growth there. Any other questions that we see?
I'll just mention that, for anybody that does have additional questions, always feel free to contact us. Our information is shown on the slide in front of you guys right now, but we're happy to dive into any more detail on any sort of the cash flows modeling or any of the organization of the deal. Happy to answer any of those questions offline as well.
Yes, and this is, of course, a recorded webinar, and you will automatically get a recording here following this webinar if you want to come back and review it. Additionally, I want to add, after this webinar, there will be a full business plan available on IMS. I have to upload it, just got approved. I will upload that business plan so you have access to that, and you can dive into whatever section you want to review it in more detail. But I do want to move on here with the remaining time we have and just talk a little bit through the subscription process. I know a lot of you have been sending emails already. I'm getting a lot of responses in my inbox of how do I subscribe for this. Earlier today, I did send out a slide brief, a very simple slide brief on how to at least get access to the investor portal. But an even easier way than that is just send me an email. And with your email, you have your first name, your last name, and I will put you in IMS portal and send you an invite. Once you get the invite, then you can create your login credentials with your ID and password. And then once you're in the portal, you go to the offerings tab, in which then you will see the Towers on Main offering available to you. And what I would do here real quick is to share my screen, and I'm going to show you that. Just go right here. When you log in, you go to the offerings tab. You should be able to see my screen. Will, do you see my screen?
Yep, good to go.
All right, excellent. The Learn More button there. Click on that. Again, this is after you have your login credentials satisfied with the IMS system. Then you can log in on your own, hit the Learn More button, then you hit the Invest Today button, then you go through the process of signing up. It's fairly simple. Of course, you're an accredited investor. If you have any questions, though, if you're first time going through this process, no problem. Give us a call, give us a ring, reach out to us. We'll help you walk through these documents so that you understand what you should put in each of these sections. But just wanted to show you that sometimes it's easier just to show versus try to explain it all together on the slideshow. And otherwise, you can send me an email and I can give you access. I did have a slideshow up and it is not there anymore. But that's okay.
We are going to wrap up anyway. Well, thank you everyone for taking the time from your evening to spend some time with us to go over this opportunity. As has been said before, feel free to reach out to any one of us if you have any questions as you go through the process. With that, we will say good evening and a good night. Thank you.
Thank you.
Thank you.
Good night.